Today I'm going to talk to you about the value of independent financial advice, and I'm going to base it on a white paper that was written by the company Vanguard, which is a very reputable fund manager. It was written a few years ago, and what they did, they based this on their research where they looked at a number of factors that could increase the value of the financial advisor to you as an investor, and they came up with 8 categories. Now I can't recall all 8 off the top of my head, but let's say 1 to 8. Vanguard. And this study was called Advisor Alpha. Alpha being the extra you get from using an advisor, the extra value you can add, the alpha. And so what they did was when they looked at these 8 factors, and some of the ones I can remember off the top of my head, one might be based on, say, charges applied to your investment. Another might be helping you to make the right decisions, to stay on track, and we would call that behavioural finance. Stopping you selling when prices are low and buying when prices are high, for example, behavioural finance. It was helping you manage your taxation better, so you maximised all the tax reliefs and allowances and used up all your capital losses, for example, all those kind of things. And there were a number of other areas, 5 others, but they were not quite as important, I think, as these 3 main areas. And what they concluded was that the value, the advisor alpha, the added value that the average advisor brought to a client was 3% a year. Now, some might argue it's not 3%, it's 2%, or it's 4%, who knows? But they weren't talking about the value purely in terms of extra investment return each year. They were factoring in the effects of all this other advice, the impact on the returns for the client. So, for example, if you keep the client invested in the market rather than selling when prices are very low, then they'll get an extra return that way, almost certainly, based on history. And if you could pay less taxation, that's got a benefit, a value that you could equate into an annual return. So it's based on a number of factors, but what I believe is when you consider that the typical independent financial advisor would charge perhaps 1% a year for assets under management, so that's the advisor fee, typically. When you take that into account, if you accept that this independent study, this white paper, shows that the average return produced by an IFA is 3% a year, and you're typically paying 1% a year, then that's 3 times the value that an IFA, an independent financial, brings you, and I think that's fantastic value. I hope you agree.